Building on our action to help you afford a down payment, we are now making the boldest mortgage reforms in decades to unlock homeownership for young Canadians. That's what Chrystia Freeland said in her announcement. The Liberal government's updates and changes to the CMHC mortgage insurance portfolio in September 2024. Now, whether or not you believe this is the boldest change when it comes to insurable guidelines, there is no doubt it's going to have a serious effect and an impact on the housing market. As if we need to add more fuel to the fire at a time when the buyer's market is actually in full swing. We have condos available in certain cities like Toronto that are ready and ripe for the picking. And we have sellers markets in only a few cities across the country, namely Edmonton and Calgary. Essentially what happened with the changes from the CMHC initiative is a little bit more fuel to the fire. So for the sake of conversation, what we're talking about is the CMHC insured guidelines, which, believe it or not, have a much bigger impact on the marketplace than just people who are buying homes with less than 20% down. There are some hidden factors that we're going to break down today in this here video. Let's start off really quickly here and talk about what these actual changes are first and foremost. Let's talk about the big one, the price cap for insured mortgages to $1.5 million. Now, when I saw that getting announced, I saw a lot of comments from people saying, well, who the heck is buying a property up to 1.5 million with less than 20% down? But I think a lot of those people are forgetting a few key points. But before I get into it, let's talk about what this all means. So before the announcement, essentially, if you were purchasing a property and you had less than 20% down payment, you only had the ability to buy a property up to $999,000.99. Anything above that no longer had the ability to have insurance, which means all of a sudden you had to have 20% down. So you went from having to have $75,000 to $80,000 to now you need to have $200,000+ available in down payment. And while some argue whether or not that's right or wrong, the reality is in some of the markets like Vancouver and Toronto, there are people that have very successful careers and are making a fair amount of money, and they just hadn't had the ability to get the down payment required, whether because they had to pay off student loans or other debts or whatever reason. And at this point right now, it doesn't matter what the reason is, the government is essentially saying we want those people to be able to purchase properties. I mean, when they came in the $1 million rule, that was over 10 years ago, and at that time, real estate values were significantly different. Now, the second thing, which is the byproduct of that, which is important to note, is not only do you require less capital, so on a $1.5 million home, you now need about $125,000 minimum down payment. That's assuming you qualify for that large of a mortgage on that kind of property. That's about half the amount of down payment or less than what was required before. A significant difference in the ability for someone to get into the marketplace. And if we look at it theoretically, this is the difference between someone having to wait for a massive gift or look at a property that didn't work for them in the first place, or potentially wait 5 to 10 years to be able to buy and have those properties outpace them in the marketplace. So there is definitely a boom in some of those major cities, although we don't imagine the uptake is going to be massive across the board. The second thing is in regards to mortgage insurance, this is going to be a huge door opener for people who are in the marketplace for a mortgage. You see, when they made the guidelines for the rules $1 million, when it comes to the end of your mortgage term, right now, your options for lenders are pretty minimal. If your property value is over $1 million, you no longer qualified for mortgage insurance. Now, if your property is between $1 million to $1.5 million, some of the non-bank lenders who have to insure their mortgages, like MCAP and First National and many of the other ones out there, they may be able to offer you insured products, which is going to actually provide better rates and terms for people that are coming up for those renewals. Now, we'll be curious about how this all works and what happens if someone bought the home for less than 1.5 and if they still qualify when they bought before, or if it affects people afterwards. Anyways, point is, it is going to be a good thing for people who are coming up for mortgage renewals, which is only good for the marketplace. The other thing that we could see happen is it could definitely stimulate the overall insured market. Since 2020, the amount of people purchasing with less than 20% down has significantly declined as there's been a great wealth transfer. And so it's very likely that we'll start to, stimulate that marketplace as a whole, and we'll see more people get into that marketplace. Now, an interesting stat on that is that right now insured, which is less than 20% down, mortgage holders hold up about 19% of the entire mortgage market, which is actually pretty crazy. But as of the second quarter of 2024, only 3.2% of CMHC insured mortgages were for over $850,000. So chances are at this point right now, there's probably not a significant stimulation to the marketplace for people purchasing property over $1 million, but there is going to be a small percentage of people, and we'll be curious to see how many of those people buy over $1 million. So with that being said, a lot of the ramifications from this we'll be talking about more as we learn more information over the course of this week and the coming weeks when it comes from lenders. But for the sake of conversation, we give that first actual guideline change a pass purely because this should have happened 5 years ago or 7 years ago, and for no other reason than the fact that it's going to create more competition for people at renewal time and not be only stuck to their existing banks and lenders. It is going to provide more lending options, which is good for the marketplace, and it means better choice and better rates, which is good for everybody. Number 2, all insured first-time homebuyers can get 30-year amortization. So originally when this was announced, the first couple of articles that came out suggested that basically if you were a first-time buyer, you could get a 30-year amortization instead of just buying it on a new development property. You could get this on all properties, but we found out pretty quickly right afterwards that the rules suggested that now every single person who's putting down less than 20% on a property can now essentially qualify for a 30-year amortization. And this is significant news because essentially more or less that's a 10% difference in your monthly payments or the ability to qualify for, again, significantly more, up to 10% more. So when you look at it from a context perspective, if the average person right now, especially first-time buyer or a person with less than 20% is significantly shorthanded in being able to get into the marketplace, well, this is going to give them the ability to upsize maybe from a 1-bed to a 2-bed, or maybe just to a nicer area or to a bigger property, depending on how much money they're putting down. But it is a difference, and it also gives them a little bit more affordability. Yes, we know 30-year amortization has a higher amount of interest, but remember this, you don't have to take a 30-year amortization, take 30 years to pay it off. You could pay it off faster if you wanted to, but if it's the right opportunity to get someone to the marketplace at that time, there's a lot of value in doing this. The thing about this is all insured, let's break this down, by the way. All insured first-time buyers can get 30-year amortizations, which basically means that anybody who's a first-time buyer who qualifies, so essentially hasn't owned a property in the last 4 years and qualifies under the federal guidelines, can purchase a property with 30 years. So it doesn't have to be resale, and it doesn't have to be a new development property. We'll get more to that afterwards. This means that there's a lot more of the marketplace that was stimulated and answers one of the big questions that people were asking when this originally came out in August, which is why only new development properties? So this really addresses, I think, a need right there. But the reality is, I mean, listen, we have a shelter inflation issue right here. This does not actually effectively help out anything on the supply side. This is basically a demand consideration. So while I do believe it definitely helps out that entry-level crowd, it probably fuels that entry-level fire and price point, it probably won't do significantly more than that, and it will likely just end up increasing home prices, and that's what I would suggest would be likely to happen. Okay, let's talk about this 30-year amortization for all people now. So anybody and everyone can actually qualify, doesn't matter who they are, as long as they're putting less than 20% down to purchase a property if it's a new development. Now, this one is very focused on getting people to purchase new properties and stimulating the development market, essentially saying, hey, we want to build these 4 million homes, and one of the ways that we're going to do that is we're going to incentivize more people to buy new development properties. And while I do believe to a degree this will actually stimulate the market, especially for people who are looking at new developments anyways, I don't know that it will sway people significantly to all of a sudden put less than 20% down, because as we know, buying a new development property, typically speaking, is a more expensive proposition between GST and the fact that you're buying a brand new home. So there'll be some movement, and it's a way to get people to basically jump in and purchase those new development properties and own them for themselves, especially if they can find them at value at this point right now. But the question really is, why couldn't we have just done this for everyone? If you're buying less than 20% down, 30 years amortization across the board. So they focus predominantly on getting new builds moving. And listen, at the end of the day, I still think this ends up being actually a good thing in the long run, because it gets to stimulate the developers and get them putting more shovels in the ground, which is really a good thing as far as getting more supply out there. So as a whole, 3 new things. What could actually happen? 3 new rules. What could actually happen from these different rules? I think number 1, it could change the market tone at this point right now. There's already a ton of predictions out there that 2025 and 2026 will see a significant uptick in buyers in the marketplace, with a lot of people sitting on the sideline in 2023 and 2024 only slightly being stimulated, but having that higher demand. The immediate predictions that I'm seeing across the marketplace are that we're going to see a higher amount of stimulation. I don't expect any 2021, 22 action here with numbers going across the board crazy. People don't have that kind of cheap money, but with rates going down and with these new rules coming out, there's no doubt it's going to bring buyers to the marketplace, which is going to create more positivity in the marketplace and probably erase some of the negativity. Although, let's be honest, if you're watching on YouTube, there's a lot of negativity and you're probably going to leave a nasty comment. So please leave something more thoughtful. Number 2, I believe that what this does is it somewhat raises the potential floor as far as where the BOC was going to go. I mean, ultimately we saw that they were going to potentially drop the overnight rate to like 2.25 or 2% in some situations. This might bring the floor up a little bit as it stimulates the overall economy, but again, we'll wait and see what that actually looks like. So the question mark is really, does this have a meaningful impact in the marketplace? And the answer, in my opinion, is yes and no. It has a meaningful impact because Ultimately, it's providing people with more options, more choice, and the ability to qualify for more, especially immediately. But the reality is if it brings up the price floor, then in effect, some of these different rules will be, well, useless in a couple of years, probably within a couple of months. I do think that the $1.5 million insurable change is significant, not just for people who are actually purchasing properties at 1.5, but for the ability to negotiate better rates and terms and provide the competition outside of the big banks more leg to stand on. This is a good thing for the marketplace. If you want lower rates and terms, you want this. And I think at the end of the day, while you might not recognize it from a purchasing perspective, it's going to help you on the mortgage side of things, especially if you had an insured mortgage to begin with. So we can all clap and applaud for that to come through. Is this just another play from a political perspective to be able to get more votes? Yes, clearly, obviously it is. And I'm not going to get into politics here at this point right now, but they did do something that people have been asking for a long time. And yes, they could have gone further and done more. But at the end of the day, they have addressed at this point the demand side, which is what people want. The question is, how does this impact the supply side of things? And that is the question I will leave you with today. So leave your thoughts down below. Let me know, what do you think that this is going to do for supply, demand? Is it going to go bananas? Is the market going to go nuts? Are they going to address supply with this? I'd like to hear your thoughts.